Good day, fellow investors. A great comment here by Ivan discussing why so many food stocks have fallen lately. ADM, Nestle, Hormel Foods, Pepsi. What's happening with the sector? Let's investigate a little bit and see whether there are opportunities in the food sector. But before we start, I want to discuss that there is food and there is food brands. Those are two completely different sectors. This is simple food trading company, buying grain, storing it, selling it, processing oils, whatever, carbohydrates. Then this is brands. From Nestle, I think all the kinds of brands that they have, they're crazy. Or if we go to Pepsi, the brands that let you sip, savor and smile wherever the craving strikes. These are brands and this is not food. So these are two key trends that one has to understand before investing. Let's discuss food. Food, when it comes to investing, is related to food prices. Globally, there is the World Food Price Index, and things were, let's say, negative for food processors and producers for a few years. Then we have the pandemic and the boom there, and now things have subdued a little bit, and consequently these exaggerated profits here are going down. And as profits are going down, the market is always myopic. Here the world will be all profits and money will flow forever. Here it is all terrible. That's normal within a cyclical industry. If you look at the long-term food price index, you can see there is a boom, then there are high investments, then there is a downturn leading into a boom, high investments, then there is a downturn leading into a boom. But if you look at the trend, that's a clear trend. Inflation is always there, leading to higher highs and higher lows following. That is the situation. If we look at a stock like ADM, when things are very good, the stock is up, then it crashes in the downturn 50%. That's completely normal. Then it booms again 200, 300%. Then it crashes again 50%. Welcome to the cyclicality of food. Booming 70, 80%, crashing from the top to bottom 20, 30%, then booming again as everyone gets exuberant, and then it crashes again. The clear is that the trend is growing, the dividends are growing, the business volumes are growing, and then it is about waiting for that food cycle or just enjoying the dividends until you have another boom, because the company has been paying dividends for 51 years, increasing them, and 90 consecutive years of dividend payments. The comparison with food stocks, which are not food stocks, I call them food brand stocks, is this: your beloved global brands. And there is something, I went to do market research for this. I went to the store, and here in the Balkans I bought this Mr. Beast's Feastables. Of course, I had to open it and test it just for market research, and it costs a lot. It is not special, just a normal bar of chocolate. The thing is that in a store in the Balkans, in Europe, you can buy this. And all these new brands compete with all your loved, beloved brands out there. So there is not that much brand strength anymore as it was the case even 2-3 years ago. Everyone is coming in, they go to Machu Picchu and produce this in Peru, for example, for Mr. Beast. If we look at Pepsi, for example, yes, things were stagnating and then booming during the pandemic, and now we have again stagnation. Net income is just not growing that much, because it is a clear indication that there are other competitors, private labels. Kraft Heinz has been actually stagnating for already a decade. They try to improve a little bit, but it is always struggling. Nestle, if we look at total revenues, flat, of course, this is Swiss francs, there are some global benefits, but operating income also stagnating. When you put it into a stock price perspective, the P ratio there is 20, okay, on the cheaper side, especially when compared to European stocks that we discussed yesterday, where things are crazy except ASML, that is a buy from a risk and reward, and now the stock of Nestle jumps because they show 2% growth. A little improvement, but the free cash flows are 10 billion. Okay, 10 billion, that's 4 or 5% free cash flow yield. That is crazy expensive, but that is the market we are living in. For me, still too much risk, and maybe it will go up. There is too much risk that all I get is a 3% dividend over the next decade. That is not even enough to cover for inflation. Maybe it will go like this, but maybe it also continue to deteriorate, or needing to spend those free cash flows on acquiring Mr. Beast Feastables for 10 billion and making him rich. That was a great time on those margins, and now we are again sluggish, and we'll see how that goes forward. We have discussed a good number of these food brand stocks: Hershey, J.D. Peet's, which is the cheaper comparison, Kraft Heinz, and when I look at things, yes, this was a boom, but now things are just stabilizing, and if you look at the long-term trend, we are still on or above the long-term trend. If we look at the P ratio there, you can see that there are always these booms on some issues, perhaps some impairments, but this was really a great time, and now that is slowing down, and consequently the P ratio goes from 30 to 18 and the stock goes down. There is nothing wrong with normal valuations, and this is just market adjusting to the new situation from the exuberant situation. If we look at J.D. Peet's, this is then related specifically to coffee. If coffee prices go up, their margins unfortunately here go down because they can't transfer prices to consumers that fast, but they are keeping their market position. And when coffee prices go down, their profits will go up. So that is a different cycle, which makes it interesting. And there is also the dividend yield, but there is also debt. You can check the video. I will put all the links to the videos we discussed here in the description of the video below. There are a few more videos of food stocks that we have discussed. Then we have Kraft Heinz. The dividend yield there is already better, but you can see here it has been also struggling, as it has one brand and the others are not that beloved as some other brands, or don't strike the craving that much, how they say there. We have also discussed Mondelez, Guess. We are all at the same ballpark there. P ratio of 17, yield of 3%. General Mills is again cheaper but likely lower brands. And Heineken just exploded today because there are some slight improvements in earnings, and suddenly it explodes because everyone expects it to go back where it was. But to me, this is just crazy numbers. Pepsi, P ratio of 20, and keep in mind when Warren Buffett bought Coca-Cola, the P ratio was high at 12 in 1988. When we compare these things, the thing is that yes, compared to the market and the P ratio 30, things are cheap. Just look left and right, up and down, things are cheap. However, P ratios of 20, 17, 15 are still not absolutely cheap. Those are relatively cheap. And if you look at the dividends, 3, 4, 5%, compare those to the 10-year treasury that is the driver of everything. This means that dividends should be at 6% from businesses. So the market hasn't yet adjusted to this because everyone expects those rates to go down. Inflation is persistent, so things are still risky from a risk and reward perspective. I have discussed those brands and I'm struggling to find how they will maybe some will do better, some will do worse, but I'm not going to take the risk. I just know that maybe I'll get to a 5, 6, 7% return, hopefully over the next 10 years, if perhaps the private labels subdue, if Mr. Beast doesn't enter new markets and things like that, because the competition is very high. And let me know also in the comments whether those brands are as strong as they have been a few years ago. So the conclusion is, yes, good businesses, good brands, everything good, but are they good enough, and can you maybe find something better for your portfolio? I know that population is growing, demand will be higher, investments are already made, boring, slow and steady business, that's value investing. We'll update on Nutrien when earnings come in. That's a little bit more tricky as it is the fertilizer cycle and there are some new games plays in town, so I'll have to check that. Compared to the rest, yes, it is priced there, some likely lead to good returns, but again, not that stellar. Thanks for watching. Check my research platform for portfolio stock, 21-day money-back guarantee. Feel free to check it out, see if it gives value to you.